Hello, and welcome to this week's edition of the Mentor Club. Hard to believe, but it's already January 13th, 2020. This is Noah Davidson here, flying solo this week, and just wanted to welcome everybody out here. We're going to have a wonderful time here together, and, really excited to have you here, have the chance to fly solo today. So let me go ahead and bring up the old disclaimer. As always, want to make sure that we do this properly. Again, a couple things about the disclaimer here. Just that, trading and investing involves risk, that we make no implied warranties or guarantees. And again, past performance does not guarantee future performance. And we really encourage you to master these things in a virtual account to build your confidence and skill set before you go live. Now, that being said, proper disclaimage there. Let's go ahead and dive right in. And I'll tell you what, Andy and I and Corey Holiday last night, we got together and we were on Andy's podcast together. And we talked about the 401k and, the way Americans save and some of the challenges and issues with that. We had a great time. It was really an amazing podcast. So if you haven't had a chance to check out the Cash Flow Academy podcast, make sure you're doing that. And, this would be a great one to start out with, especially if you're new to us. And if you have a 401k, there's a lot of things to consider there. So it was an awesome little podcast, and I think you'll really enjoy it. So that being said, let's go ahead and just dive right into the market. And the market's right up here near those all-time highs again. I got a chart of the S&P up, and we've got green candlestick today. And let me zoom in on that a little bit and bring it into scale. Let me see if I can pull that down there. Boom. Okay. All right. So again, upward candle. So far, we're on a little below average volume for the session, but we're just right up there underneath those all-time highs on the S&P, and we're seeing a lot of really good activity out of the market. Thought I would bring up FinViz. A couple things I wanted to cover, and I thought I'd bring up the little heat map on FinViz, and a great place to start your trading routine. So the little heat map, again, finviz.com. Let me show you how to get there. When you go to finviz.com, you can either just click on the map here. You can hit map up here and you might want to turn your pop-up blocker on. I got to go figure out how to turn that pop-up blocker back on. I'm operating on a new computer, so I have to go update all my settings. That heat map showing a lot of green today, except for I do see red in healthcare. So I know that the healthcare sector is seeing some selling pressure. I'm also seeing some of that red bleed over in the healthcare into the biotechs. Oil and gas is not doing as hot, but we are seeing some strength out of some leaders like Netflix and Nvidia, CRM, Facebook, PayPal, and GE's got a big green box there. And we're heading deeper and deeper into earnings season. And one of the nice little features here on FinViz, you can actually change that heat map. We're looking at a 1 day performance. We could swap that out to a 1 week performance, a 1 month performance. And then you've got these other choices down here for like fundamentals and earnings date. And as we head into earnings season, a couple of things that'll help you out here is if you look down at this little scale down here, you got this color, these shades of magenta for the stocks that are before earnings. So darkest shade of magenta there is 30 days out or more. Middle shade is 15 days out or more. And the brightest shade of magenta there is right before earnings, so within 15 days. And then brightest shade of cyan is after earnings within 15 days, beyond 15 days, and then past 30 days. And as you look at that, we are seeing a lot of magenta on the heat map. And, we've got a couple of people who just reported today, like JP Morgan, Wells Fargo, Citigroup just announcing. We got Bank of America coming out soon. So the financial sector is announcing. And then after that, looks like you've got some of the other financial, services and insurance things and things of that nature. They're reporting soon. Looks like, again, we've got a handful of other candidates that are getting close to reporting. We got United Healthcare, J&J, And then some of the bigger fish are, a little bit more than 15 days out. And as you approach the market during earnings season, it's really, really important to be aware of earnings. So I wanted to highlight that. We'll be talking about that here again a little bit more in a moment. But in the meantime, let's go check out the broad market indices. And again, S&P posting right there near the all-time highs. From a weekly context there. Again, we can see how the market's popped up and it's having a good run. I backed this all the way out and I had a monthly chart open. Let me back this back out to the monthly. I had been showing some max data on a monthly chart. And just to put this into perspective of where that S&P index is, and this is data going back to 1980s, but we're again near these all-time highs, and boy, it sure is rocketing. And if you kind of look back at where we are from the highs back in 2007 and 8, the market's really more than doubled. We went from a high of 1600, and here we are out in 3200. So boom, pretty impressive strength in the market. From a technical perspective, and Andy and I often talk about this, and you're probably aware of this by now, that we talk about some of the fundamental uncertainties of the market and the valuations and, price to earnings ratios and things of that let us know that the market, certainly we have reason to believe that it's overvalued, but that doesn't mean it can't keep going up. So we're going to continue to ride that trend while that trend persists. Let's take a look at the NASDAQ. We'll look at the NQ, and the NASDAQ actually is posting an all-time high today. So right there, boom, slightly, a typical volume, not quite above average yet, but typical volume. And that looks like that's leading the charge there. So NASDAQ looking nice and strong. And then let's take a look at the Dow Jones Industrial Average there. Just hovering below the high, up above all the moving averages. Not quite near that all-time high, but not far off of it. And again, showing us, steady little trend. And for all, intents and purposes, the market is showing us a lot of bullish strength. So now, as we look at the NASDAQ, let's shift over, and we've looked at the Dow. Let's look at the RUT. And the Russell is got a little bit of a bullish flag pattern in here. Let me back that out to the weekly. We're not near the all-time high. We got a ways to go to get to those all-time highs out at 1746, but it's a pretty bullish little move. And again, I've got a little kind of flag pattern drawn in there. So I have reason to believe that we might see some bullish activity out of the Russell. And our iron condor is doing really well on right now, and we'll take a look at that here in a moment. But it's, pretty good move. And again, not as bullish as the other indices. So the small caps and the mid caps, they're bullish, but they're not as strong as, say, the tech sector. So just something to keep in mind there. And I always like to get a look at things like the US dollar. So I'll always look at the dollar index, DXY. And the dollar index, to me, has got a little bit more of a bearish look right now. Now, overall, the big picture, I think, is neutral. If you look at that on a weekly chart, the dollar's kind of chopping sideways. From a daily perspective, it's down below that 200-period moving average with a couple of selling candles, and almost looks like a little bit like a bearish retracement up into the support resistance zone. And I wouldn't be surprised to see the dollar drop a little bit. And I always like to look at the commodities. I always like to look at the price of oil, the mother of all commodities. And it really rocketed up on some of the geopolitical news and some of the geopolitical risk. And we're seeing it correct back down into the moving average. And there might be an opportunity in here for us to sell some options on oil, look at maybe some credit spreads. And actually, I put a couple of these in the portfolio they're doing okay. They're break even right now. But the general idea is I think they're gonna stay above $55, $56 a barrel in the near term, and they're pressuring that 200-period moving average here near 57. Won't be surprised if we see that recover. I always like to take a look at precious metals, and the reason I like to look at those because we do have a couple positions. We do have a position on gold. So gold really shot up to new highs, and again with prior to the geopolitical news, but with the geopolitical news, we saw some increase in volatility and a pullback down into the support resistance zone here at 1547-ish. And there might be opportunities in here as well, and I also have a couple positions in there. Sold some options on gold, I believe futures. We'll double check that here in a moment. So gold and silver, if you take a look at price of silver, it looks Not as bullish as gold, but it did pop up to a newer high, not an all-time high, but a recently new high. It popped up, pulled back down to support resistance zone there near 18. So looking pretty good there. And then I always like to take a look at things like the market, the breadth indicators, like the volatility index is one that we can look at to get an idea of what kind of implied volatility we're looking at. VIX is hovering down here near 12. It spiked up momentarily off of some of, again, the volatility increase with the geopolitical news. But it's settled back down here and, at 1253. So we know the options aren't outrageous. But as we get into earnings, it's really important to pay close attention to where our implied volatility is so that we know whether we're paying too much for options or getting a good deal. And we just need to be really aware of when those earnings announcements are. One of my favorite indicators for market breadth to look at is the Archipelago AR high 3M months. So that's the ARHI 3M minus the $ AR low 3M. So that's the Archipelago clearing network, and it's measuring the last 3 months of the stocks that clear on the Archipelago network, which is the biggest clearing network that there is. And these are stocks that are establishing new highs versus stocks that are establishing new lows. And you got 309 more stocks establishing new highs than lows. And that's very bullish. So we're seeing a lot of bullish activity in the market, which means our bias is definitely bullish. And that's not to say that there's not some bearish opportunities out there, but those are the things we would be looking at. So now, going back to that heat map and looking at overall market performance and earnings date. And again, this little heat map is a very valuable tool if you're not using it. Again, FinViz is a free website. And we can go look at PE ratio, for example. And we got a lot of stuff that's overvalued. Bright red means overvalued. That means PE ratio is over 30. So we know that things are at a premium right now, even though we're in a bull market. Well, why would people pay more than what's considered fair value? Well, that might be because they're looking at a forward growth rate, like a forward PE. You notice when we change that to a forward price to earnings ratio, the future forecasts bring a lot of stocks back down into fair value territory. And you see a lot more green and neutral, where you're seeing things, fair valued under 20, under 15, even down as low as 10. So that, forward PEs look good. And another good one that you can look at are what are called PEG ratios. That's a price earnings growth ratio. And when you look at a PE growth ratio, there's a handful of green candidates out there. Not surprising to see a company like Berkshire in there. A couple of others that, look fair. So that's something you can consider as the fundamental valuation, particularly for your investment type candidates. So lots of, useful tools here. I'll switch back in and take a look at that earnings date and kind of get an idea, again, companies that are getting closer to reporting earnings. So got a handful of candidates, and just really important to pay close attention to when earnings dates are. Inside of your Thinkorswim, you've got those little earnings icons on the charts. If you're using a Thinkorswim platform or another, type platform, they oftentimes will put those things on the chart. So, we've got, we'll go through our positions here in a moment, but I've got a position on Apple, for example, and I can look out here and I can see on the chart, they got earnings coming up at the end of the month on the 28th. Well, that's really, really important to note. So we're aware of that. So we're not just caught off guard or surprised by that earnings announcement. Another one of my favorite websites to go and check out is earningswhispers.com. And Earnings Whispers, if you go to their homepage there, it's another free website where they crowdsource information, and they have a couple things in there that are helpful. They put out a little calendar. You can kind of, scroll down and see who they've got, highlighted, in the news here: FedEx, GameStop, HPE, Hewlett Packard. You can go click on their little calendar. You can get a look at who's on the earnings docket for the day. You can also switch the view on there and look at it for, earnings docket for the week. And again, you can just kind of see who's coming out on that earnings calendar. So I can say, okay, well, let's see who's reporting on Tuesday. We got JP Morgan, Delta Airlines, Citigroup, Wells Fargo, Info, WIT, FRC. And it's important to pay attention to stocks in similar sectors. So I notice here I got like JP Morgan, Citigroup, Wells Fargo. And if I have any of those positions in my portfolio, So if I'm looking at, portfolio here and I kind of go through our current account positions, and if we have any financial stocks in there, we'd really want to make sure that we were aware of that. And I don't think we have anything off the top of my head specifically in the financial sector. And one of the reasons we don't is because their earnings they're about to report, and some of these other companies, as they get closer to reporting earnings, we'll want to make sure that we either close out, take a profit, batten down the hatches, buy some protective puts, things of that nature, to help us protect against the surprise that earnings can be. So that's kind of what's on my mind this morning, taking a look at the market, and that's really what I just walked you through there. Again, is kind of my typical daily routine, just running through, seeing what's on, going on in the broad market. It's always, I think, wise to get a look at, headline news. So a couple of my favorite news aggregate websites, right there back on FinViz. If you go back and hit the news page on FinViz, you got a news aggregator here that just shows you market news and information. That's, very, very useful. I also like to look at briefing.com. And briefing.com's got a pretty decent little website for financial news. Again, it's got a little financial news aggregator. And you can just go click on, stock stories or stock market update, and you can get a quick, here's what's going on with the market snapshot, what's moving the market, and just quick headline news. And, you don't necessarily need to dive in and read all the news, but you want to be aware of headline news. And so I'm always looking for just headline news, stuff that's of interest, so that I'm not unaware. But again, I don't like to chase the news. I think chasing the news can be an exercise in frustration. It can keep you kind of chasing your tail a little bit as we're always searching after, what the market can do. So checking the, broad market, checking your news, making sure you're going through. And then I always, of course, like to go through the portfolio. And if we go through our portfolio here, first of all, I want to show you guys, let's go take a look at the monitor page. We're absolutely crushing it in the portfolio here. We peaked up over $40,000 in returns. I've been leaving the market running bullishly, kept some of our winners running. And, like Andy and I often talk about, a Pareto distribution where a whole bunch of those gains are coming from two positions. Apple's got a huge gain. Paycom's got a huge gain. Lulu's got a huge gain. And then we got a whole bunch of modest gains in there as well. Oh, we got NetEase is also, very positive gains. So we're crushing it right now. Absolutely crushing it. And I've got this switch to the old layout. I'm kind of old school. I've been trading for 18, almost 20 years technically, if I look back. But when I really started my financial education, I don't like to count my trading days before financial education as much because I had no idea what I was doing. But looking at the new layout here, you'll get similar data and information. And again, you can get your Greeks kind of laid out for you and profit and losses. So whichever layout you're using is fine. I like the old layout just because of the simplicity of it. And check out our delta. Look at our delta column. And we got a really big bullish delta. And something that I've been working on the last week, in addition to letting our winners run, I've been working on building up our theta. And you'll notice I got the theta column up to 248 down here. So we got that theta column up to 248. So let's get that right there. And boom, big fat theta, cash flow. So I've been working on that. And the way I've done that is through selling covered positions on, on some of the stocks that we have, and adding some, bullish credit spreads, naked puts, things of that nature to the portfolio. So we'll go through the portfolio and kind of go through it at a healthy clip here, kind of show you what I've been up to. I did something new that we haven't done often here in the Mentor Club. I sold some put spread, a bull put spread on gold futures, and went and sold a 1,500 by 1495 put spread on gold futures. So let me show you that real quick here. And selling options on futures is giving you kind of some leverage on top of leverage. And the general idea on this is relatively simple. I like the price of gold and the bullishness of gold. And with that retracement that it put in, I thought we could set up a little bull put spread. So I'm going to go set this price slice to break even here. And this is a position here. I'm going to go set that to the chart. and we'll take a look at the chart. And basically, this is simply a bet that gold stays above 1,500. And it's trading up here at 1,550. And there's, support zone here. There's another support zone back in here. There's another support zone back in here. And I've got an alert set up to let us know if it dips down below 1526. And it's got rising moving averages. And just a simple bet that it stays above 1,500 in the next couple of weeks. And again, if you take a look at this one's got 77 days until we got 18 days on the options there. 17 days on the futures contract, but 18 days on the options. They expire on January 5th. And, I got that backwards. That's 1 by 100, January 20s. So we got a few days there, and, we're sitting here on a nice little, bullish retracement and just sitting on the futures, and it's got some leverage. The maximum gain to be $200. The BP effect is about $2,000. So we're looking for a 10% return. And we'll see if that, and I've got an alert on that. Just keep an eye on it. Next on the list here, Apple's just crushing it. And we've capped our gains on Apple. We actually sold calls. And so in hindsight, we could be doing a little bit better. We could be up 14 plus thousand, but I sold the calls. And it's moved up past the strike prices. And the reason I sold the calls on Apple is because I thought that the Apple was a little overheated heading into the end of the year, and I wrote covered calls on it heading into the close of the year there, and it's just pushed a little higher. I still expect a correction. We have earnings coming out here on the 27th, and these options expire on the 24th before earnings. So if there's potential we could get called out, and if we get called out, we'll have a $10,899 gain. That'll be fantastic. It brought in just a little bit of, risk, and we're basically getting paid $1.33 for promising to sell it at 300. So that's the same at selling it at 300, and $1.33. So a little extra premium in that, and that's bringing in some positive theta. That's worth 50 points of time decay right now. So that helps us right there. Applied Materials, just kind of break even little trade and just a couple long calls. And let me show you the chart on the Applied Materials. I was watching Applied Materials for a bullish breakout here, and it's got the upward trend, which we can see here. Let me get my drawing tool out, and you can see the upward trend. And then really what I'm looking at here is what I kind of considered a potential breakout inside a little consolidation up here. So I'm watching to see if it can poke up above that high. And I like the breakout here. Earnings is not out for a couple of weeks on this. We don't have to worry about earnings until the 12th or so of next month. So we got a month until they have their earnings announcement, and I'm just watching for the breakout, and we've got some long calls on that. Same thing on AMD here. AMD, I take that back. We got a call spread, and I reduced the risk on this call spread on AMD. Let's go take a look at the chart on AMD. And this is capped out. We're at maximum gain on AMD. We have no risk trade, and we're at maximum gain. So we might as well just take the profits on that and lock in the gains. We don't need to do anything. We could let them expire, but I always like to sell those where I can. So we're going to go create a closing order, sell the vertical, sell it out there for the $5.99, and see if we can get filled. That ought to be nice. We can get filled on that. Next on the list here is CRUS, and CRUS is... We've got a, 1 by 3, 6 by 3. It's a butterfly, if I'm not mistaken there. And this is one I turned into a butterfly to reduce the risk. Got the risk down to $210. And my expectation now is that this stock stays up here in this ballpark. And let me go set the price slices on this to break even. We'll go set the slices to the break even point at expiration here. And maximum profit is going to occur here at $90. So let me add that in there. That's the ideal profit target. And I'm going to set those to the chart. And when I do that, that's the ballpark I'm expecting the stock to stay within. So I'm basically saying I think this is going to stay above 80. I don't think it's going past 100. And my sweet spot for profit target's at 90. So hopefully we're going to continue to rise up to 90. And these options are good for 67 days. We're going to get, as we get under 2 months, the time decay is going to start kicking in. And I turned this into a butterfly. This didn't start out as a butterfly. I turned it into a butterfly to try to get that risk down. And this trade started out with long calls with $1,200 risk, turned it into a debit spread, sold $90 calls for $2, and then I sold two more, or sold three more, so we got 6, and then bought the 100s out there for 75 cents. And again, that leaves us with a total net debit of $210. So not a lot of risk. But if this heads up to 90 and the time starts to decay, we're making $600. We're already up 300% on capital outlaid right now that we still have left in it. And once this time starts to kick in, there goes our AMD. Once the time starts to kick in, that will have a nice little increase in the theta. And we got a very low delta, and we got a nice profit on that. So that one's pretty cool. Disney's working well. We've got covered calls on it. We're winning on the stock end. We're winning on the covered calls. So Disney's one I really like from a fundamental perspective. So many resources. We got the calls out of the money there at 147. It's trading down here at 143. Take a look at the chart. The stock price has been pulling back down into the moving averages and the big old support resistance zone. And it could go lower. It could go higher. I honestly don't know which way it's going to go. We do know earnings is coming out. But by selling those covered calls, that's going to lower our cost base. And these calls are not quite at maximum gain. The most they'll make is $500. That's, again, 2 times 250 on the contracts. And we're up 360 right now. And the time decay is working for us. We got a little positive theta of 12. And we have 11 days left to expiration. And then their earnings announcement is not until the 5th. So those options are going to expire before earnings. And that's awesome. If we can keep that and manage to lower our cost base by $250, per share, and again, we've got 2 contracts out there, that lowers our cost base by $500. And that'll help us, down the road as we continue to hopefully collect the I believe we got a dividend on there as well. And we also, can, continue to write covered calls. And if we need to, we can buy protective puts. And it might be a good time to buy those protective puts before the implied volatility. It looks like we might be a little late. The implied volatility is starting to creep up. So I'll probably end up collaring this rather than trying to buy protective puts right now because the premiums are a little high. So we got the covered call paid for, and I could use that money to pay for the protective puts, but I think I'll wait, and when the options expire, I'll sell another call and pay for the put insurance on that. Next on our list is E-Trade Financial, just a little stock position with a trailing stop. It's only up $35. It's 100 shares, and it's got a trailing stop on it, and it's time to probably adjust that stop up. Our break-even point on that is 46.20. And it's just trading slightly above that. And with where the stop is, I can probably adjust the stop up. And I don't want to get too close, but I'll adjust that up underneath yesterday's candle or 2 days ago candle. Just reduce our risk a little bit, give it some room to breathe, see if it can pop up. This does have earnings later on the 23rd, so we're going to probably need to close that out prior to earnings just to get rid of the risk. Next on our list is Facebook, and Facebook's popping. It's got earnings coming out here on the 29th. Take a look at the position. This is a poor boys covered call if memory serves. And we're kind of getting to that point where we're riding that purple line up. And I'm going to want to close this out prior to earnings for a couple reasons. One, when you look at Facebook, take a look at the position here. The delta is only 14. The theta is positive, but we got a vega of 14, and we're up $462 on the trade, which is a pretty decent little return, considering that our cost base is about $1,654. We bought the 195 call for $2,170, sold the February call for $515. So again, cost base is $1,655-ish. And again, being up $450, that's a solid ROI. Gotta like that. That's a poor boys covered call is the street name for that. The actual name is a bull call calendar spread. And the reason we call it a bull call calendar spread is because we own the longer term June call, and then we sold the shorter term February call and for the cash flow and income. And again, we're doing really, really well on the long call. The short call is actually a bit of an expense right now, but overall, the way I look at it is we're riding that little purple line up. It's continuing to move, and we can close the trade out at any time for a net profit. And that's a good feeling. Next on our list is Kraft Heinz, and we got 10 naked puts on that. And this one took a little dip. The stock price dropped, and this is when Andy and I are talking about doing cost base, just controlling the cost base on. And let me get that one into the boom, where we're selling naked puts and covered calls. And so this is naked puts. It was a promise to buy the stock at 32, got paid 85 cents to do it. So the break-even point is down here at 31.15. That's where the break-even point is. And it actually dipped below that, and I was okay getting assigned on it because our goal is to turn around and write covered calls. Well, the stock price, again, it dipped down, hit the 200-period moving average. And let me zoom in on that a little bit. And it started to rally back up. So it's got some overhead resistance. It's got some support down below it. And again, it's pretty neutral to sideways. And I'm okay getting assigned on this. I don't mind assignment because once we own it, we'll just turn around and write covered calls. One of the reasons we like this stock is because that 40-cent dividend on a $32 stock. That's a solid dividend. And yes, we know that Kraft Heinz has some fundamental problems, some debt problems per se. But we're going to be working on that cost base, trying to get our cost base down lower and lower. And again, we can do that through selling naked puts, and we can sell covered calls. And this is something, again, if I wanted to, we got 11 days till expiration. Could go squeeze a couple extra bucks out of it by selling the $32 call. And again, that'll only bring in $11, but times 11 cents, that'll lower our cost base. We'll turn that into a short strangle and send that in, and boom, that took a little bit more margin, but not much, and that actually will increase our theta. I got a theta cranked up to 23, still have a slightly bullish delta, and again, now, this one risk profile wise, if it continues to rise up into that zone, we're okay. If the stock stays where it's at, we'll keep the money from the calls, keep the money from the puts, lower the cost base now 96 cents, and we're going to continue to work on that cost base. So that's pretty cool. Next on our list is Lockheed Martin. And this is one I took a stab at prior to the geopolitical news. And it's because I like the whole defense sector was setting up for a breakout. And we happened to catch that early before the geopolitical news kind of took off. And this is continuing some bullishness, and went and just bought a long call. We bought the long call here for $4.15, just one contract, so $4.15 strike, cost $935. Then as it rose, decided to sell the $4.25 call for $8.60, and that brought our cost base down to $75. So we only have $75 in the trade now, and we're sitting up about $460. And it's looking to me like it's starting to run, so we're up about $460. So what I thought we could do here is go pick some options and see if we can go spend those profits. And if we go buy this 440 call option, it only has a delta of 23, but it's paid for with our profits. So we can go pick that up, offer that to see if we can get filled there at the 380 strike, and confirm and send. And that should, what that'll do is it'll open up our risk graph again. So our break-even point at the moment is clear down here at 403, and that opens us up to potentially run. And, adds risk back on. That increased our risk back to 455. But we have that open-ended risk graph now, so that if stock price continues to run, I could see this popping and running to 430, maybe a little luck, 440. And if we got to pop out to 430, well, we're now making $900. If we got to pop out to 440, we're making, probably $1,300 or so. And so we'll let that one work for us. That's adding on a little directional move. Lulu's one of our big winners, and this is just a stock position we've had for a while and a covered call. And I sold the covered call to bring in some positive time decay. This is one where we probably need to make sure we're paying attention to when their earnings is coming out. Let's go double check there. We're past earnings, so we're good there. Breakout to a new high. And again, we're in a covered position where it's at right now, but we're covered out to 250. So out of the money call. Let it rise, let the time decay continue to work. We could roll it up if we wanted to, but I'm pretty comfortable with where it's at. Next on our list is Merck. Merck is another covered call. And this is what I did is I went in every stock position we had, just sat and wrote covered calls on it, try to bring the time decay in. Winning on the stock, winning on the call option. And again, 100 shares of the stock. Sold the strike, $90 strike price call. Take a look at that risk profile on that. and we're below the strike price. We're winning on both. Take a look at the chart. And Merck's price took a little bit of a dip. I don't see it dipping much below 87, and it's currently kind of in a pullback. So what I'm hoping to be able to do is buy back the call. And then we may want to buy a protective put on that because they've got earnings coming out on the 5th. And one of the things you want to make sure if you're going to do that, catch it before the implied volatility rises too high. So since we're winning on the call, let's go ahead and buy ourselves a protective put and just make sure we buy enough time to cover us through earnings. So the earnings, again, is out on the 5th. We could go use these Valentine's Day, 14th of February options. We sold the calls for $1.45. So if I went and picked up these $88 calls here, and we pick those up for $1, I'll put in the order for $1.45 and see if we can get the calls to pay for the insurance. And let's just double check here. We got 100 shares, 100 shares. One contract should do the trick. Let's see if we can get filled at $1.45, and then it'll put a floor on that so we won't have our risk. That may take a minute to get filled because I asked for a penny lower than the spread. Newmont Mining is just a naked put, and this was based off, again, the gold setup where, there we got filled on Merck. Let's go back and look at Merck. I'd like to see the risk graph on that. Beautiful thing about this now is we got rid of our risk. We don't have any risk. It stays above zero, so we're covered. So in this, hopefully these January 17th will expire, and we'll be left with the $88 puts. And then what'll happen here? Watch as the time decays. This is pretty cool. Try not to get too excited about this. We'll march the calendar down here forward, and after we get past the 17th, it's going to open up the risk graph. Boom. And we will have a risk-free trade good through February 14th with an open-ended risk graph. So if they had a good earnings report, we could benefit. But if they had a bad earnings report, we're not going to get hurt because we got the insurance. So we're in great shape there. That's really, really cool. Newmont, just naked puts. Just a simple bet that the stock price stays above the $40 strike. So we're just simply saying, hey, I bet this stays above 40, clear down here at 40. So we're in good shape. NetEase is one of our big winners. Look at that baby go. It's up $6,400 and got 10 shares of stock, which that's a separate trade, but I also reduced, this is a back ratio that I sold and reduced the risk on. So NetEase, I basically went and sold a couple of 360 calls, and I did that to offset some of the time decay because this one was giving us some bad time decay. And we're getting down to where we got 67 days till expiration. And that one, again, popping up to a new high here with where it's running. And the way our risk graph's set up, we can probably let that run for us, but we're going to want to take a profit here shortly. So we're going to look to take a profit on NetEase as soon as we see a sell signal. Paycom, this is one of our big winners, and this is a cool trade. Now, this is a back ratio, call ratio back spread, but I got the risk way, way, way down. And let me show you what the risk looked like before. We had $5,279 risk, and again, the way that we came up with that trade is we sold a 195 call and got paid $29.70 for a promise to deliver the stock at 195 we don't own. We turned around and bought 5 250 calls for $550, and what that did is that we ended up with a $220 net credit for the trade. And we did this because we had a bullish outlook on the stock, and the stock price has risen as expected. Boom, it's off to the races. And as I was looking at the chart, I didn't know it was going to rise today. I didn't know that. In hindsight, I might have waited, but I saw the sell signal out there. Saw that little red candle come in. And I thought, we got this, and the time decay was starting to work against it where it was at. It had this negative theta 48, and I was trying to get the theta positive on the portfolio. So I went and sold out of the money $300 calls, for the strike price, again, clear out here at 300. And this was a 1/5 back ratio, which allowed me to sell 4 calls. And that balances out the ratio. So now we've got 5 short, 5 long, and it reduced our risk down to $1,500. Our break-even point's clear down here at 250. The stock price is trading clear up here at 297. It does cap our gains, but you'll notice We're theta positive now. Switched from theta negative to theta positive. And watch where the break-even point moves. This is super cool. Break-even point went from $2.63, went down $9, and went clear down to $2.53. And again, caps our gains. But I honestly didn't really expect this to go out above 300 in the first place. And boy, today sure is surprising. Amazing there. And again, after a big move like that, it wouldn't hurt our feelings to take a profit on this. We've made, phenomenal gain on that. That's over 200% return. That is phenomenal. $5,500 tied up in $12,865. That is just crushing it. Paycom, rocking and rolling. Our Iron Condor on the Russell's working out. We're really close to expiration, just 3 days to expiration. It's given us 74 in theta. And let's take a look at that rut and take the calendar back to today's date. And we got a maximum gain of 900, and we're up about 800 and change. So we're up 825, $75 left, 3 days to expiration. I'm not worried about the stock price running. So we can let these work and try to close them out. In fact, what I'll do here, I'll go create a closing order and put in an order to buy the whole thing back for less than a nickel. And we'll leave that good till canceled and see if we can get that filled. That'll take some time for it to fill. Won't happen today. So that's working. Starbucks, covered call. Pretty boring little trade. Same thing here on Starbucks. I covered the stock position. It popped up a little bit since I sold the call. I got a trail stop working on that as well. And it just caps our gains out at $390. But it's working for us. And again, giving us a positive theta. So that was helpful. Silver, SLV, just sold some naked puts on silver with that bullish setup on gold and silver. I did the gold futures and then I just did the silver ETF and did the Newmont mining. This one's at maximum gain. So we need to close this one out. Let's go ahead and close that. We'll go create closing order, buy it back for a penny, send that back in, take a little profit. Awesome. Okay. Next is Target. And this is naked puts. We're at a $346 gain. And let's hit Target there. We're getting closer to maximum gain. It's probably, we can go ahead and put in an order to close that. And we're not quite there yet, but I'm going to drop this down to 5 cents and let that work for us to close that trade out. And if we can get that closed out, we have 95 days till expiration. I'm hoping that'll close out. And again, that's just showing that it has to rise, but it may rise. Earnings is a ways out, so we don't have to worry about that one. Next on our list is TJ Maxx. This is one I just picked up on the breakout, hoping it would run. And basically did the stock, 300 shares of stock. And I ended up selling 4 calls. I actually got one too many in there. So I need to buy one of those back. Let me go create a closing order to buy back just one of them. And buy it back for the 55 cents. Okay. That'll make it just an official covered call. So don't have a naked call on that right now. That works. That's a nice little trade. And we're getting close to being done here. UCO wrote some naked puts on the oil contract. UCO is a leveraged ETF on oil. It's the Ultra Bloomberg oil. And again, this was a bet on oil staying up. The strike price we got here is the $16.50. So this is just a bait that the bet that it stays above $16.50. And we need that to stay above the support zone down here. And it's coming down, so we may need to manage that. I might end up selling a caller on it, selling another short call on it. We'll see if that needs to be done. So working pretty well there. VST, we got looks like a bull put spread. Bear put spread. This is a bear put spread. And this was one of the candidates I actually was bearish on. Let me show you that. Not a lot of bearishness in the portfolio, but I saw this as a low base breakdown setup. I thought it might be going lower. And our spread, we have a debit spread, bear put debit. Risk is only $40. Potential reward is 160. And it is winning. It's moving in the right direction. So we'll leave that one open and see if it works. And last but not least, ExxonMobil. We got a naked puts on ExxonMobil. Don't mind owning ExxonMobil. It pays a lovely dividend. It's probably pretty neutral bias. It's got a little bit of a downward bias from the daily chart, but from the weekly chart, big support zones down in here. And again, pretty neutral. Just working on the naked put. It's winning. Let it work. And that takes care of our current portfolio. Now, there was a stock that I thought might be nice. We do want to worry about taking some profits because, again, we've locked in some gains now. I mean, we saw that up over 40,000. That was pretty impressive. We don't always see those kinds of numbers. Normally, I'm trying to keep this somewhere between $5,000 and $10,000 in profit on that. And we just had a really good bullish run. Sometimes the market really gives, and it's been very, very bullish. I got a new setup for us to check out a new candidate after we take care of our current business. I like this NetApp chart for a breakout. So a potential bullish breakout, and a couple of questions we need to answer. One, they do pay dividends, so if we wanted to own the stock, that would be good. 2, their earnings isn't until the 12th of next month. 3, their implied volatility is starting to creep up. So buying options, I'm not getting the best price, I'm not getting the worst price, kind of a median price. This would be a good time for like a debit spread. Because the median price, when I buy the option, it'll cost me a little bit too much, but when I sell the option, I'll get paid decent and it'll come out in the wash. So I'm thinking bull call debit spread. And we can go a little bit longer term out here. We can do March. We can go clear out to June. And just kind of take it from this perspective. If we buy the 65 and sell the 75, we can spend $5 and bring in $1.50 and have a reduced risk. So we'll go analyze by vertical. And if I did the 65 by 70, that'd be a $2 debit. We could probably hold out for $2. And that would give us a $300 reward to a $2 risk, which would be perfectly fine. Our delta would be just 14. I'm actually thinking we take this and we sell the 75 instead. And that brings our cost down to $333, but it'll give us a $667 upside. So we got a 2-to-1 reward to risk ratio. The net delta will be 26, and I'm thinking we could probably do 2 contracts, maybe 3 contracts on that. So put in $1,000, and upside potential's close to $2,000. Let's go ahead and confirm and send that one in, and that'll be our bull call debit directional spread. And the debit spread, again, whether you do 1 contract or 10 contracts, really up to your account size and your risk threshold. The reason I was comfortable with 3 contracts is if this breaks support at 60, we're going to get out and put the threshold to 60. The risk is about $300. So I'm going to set an alert. Say, hey, let me know if this breaks at 60.75. So I'm going to go create an alert. Hey, if this goes at or below 60.75, we'll say time to close or adjust bull call debit on NetApp. And boom, create that little note. If it goes up, we're in good shape. Again, because that implied volatility was in the mid-range, bought the option, we paid a little bit of premium, but when we sold the option, we got an extra good premium, so it kind of came out in the wash. And we got nice upside potential there. I believe this can pop up and fill the gap, probably head towards 66 with a little bit of luck, might head up towards 70. I don't think it's going out past 75, which is cool because we sold that premium in advance. And if we do, again, we put in $1,000. If we get a pop up to 70, we'll make a 50% return on investment. If we get lucky and it runs out to 75, we'll make $100. But I'm honestly not expecting it to do that. It could certainly do it by June, but between now and earnings, I'm not expecting that. I'm really expecting this to pop up, maybe run up on the high end towards 67, maybe 70. So if we get up towards 67, we'll have a 28% return on investment. If it gets up to 69, we'll have a 41% return on investment ish. And if it gets up to 70, 50%. So even if it gets up to just 66, that'll be a 15% return on the money. I hope you guys really enjoyed this week's Mentor Club. Again, it's always fun to fly solo with you. And as much as we love Andy and miss him, I enjoy our time together. Just getting to talk shop. The jokes aren't as good. That's the only drawback. Is Andy and I play off each other well. And we really hope you guys enjoy the content, and that you learn a lot from going through all this. And again, if you get a chance, make sure you check out the podcast. It was a really fun podcast about the 401ks. And if you've got 401ks, or you know people have 401ks, make sure you spread that information, because it's valuable information. And if you haven't read Andy's book, 401 Chaos, you ought to. In fact, anybody you know who has a 401k, you ought to gift them that book. You can get the PDF for free, and the book's always for sale on Amazon. It's a great read. Probably one of the easiest books on investing and financial education I've ever read, because it's just written so well. So really appreciate every one of you, and we look forward to seeing you all again here next week.